Okay, welcome everyone to the Investing with IBD podcast. It's March 29th, 2023. This episode will drop tomorrow on March 30th. I'll be your host. My name is Scott St. Clair. I'm sitting in for Justin Nielsen on vacation this week. And joining me, as always, is our weekly guest, Irusha Peiris. He's a portfolio manager at O'Neill Global Advisors. Thanks, Irusha. How's it going?
I'm doing well, Scott. Great to have you as the host this week.
Yeah, hopefully Justin comes back from Hawaii because this is a lot of work. Props to Justin. Everybody says Justin doesn't work hard, but now we know at least he's working hard on this feature. So we'll talk a little bit about the markets, especially today. Today was a very interesting day in the overall market, the indexes. Irusha and I worked together at MarketSmith for roughly 10 years. So we'll talk a little bit about that, some of the lessons that we learned, some of our favorite stories, etc. And then hopefully we'll each have a couple of stocks to put on your radar for the coming weeks ahead. So let's get right into the market, Irusha. Go ahead and pull up a chart of the NASDAQ maybe.
Yep. And you see it?
And yeah, I do.
Okay.
Sorry, I was waiting for you to go. I want to hear your thoughts first. That way I can piggyback them.
Oh yeah. So yeah, it was perfect timing for the recording this episode, Scott. We had a fall today, and so on the Nasdaq we were up around 1.8%, and the volume was higher than the day before, right? So the volume doesn't have to be higher than the average; it just needs to be higher than the day before. So it's been pretty low volume the last few days. So we had that fall today. Market goes back into a confirmed uptrend.
And how about on the S&P and or the Dow? Any thoughts there? Did they both exhibit fall through day action today?
Well, it
Looks like
depends
the
on what.
S&P did too, but maybe we're waiting for the volume, right? At this point, we're about an hour past the close of the market on Wednesday.
Yeah, it looks like if you're using 1.2% as the threshold, it looks like you got the falter day on the S&P too.
Yeah, 1.4, and the Dow we haven't really been using that at least at IBD for a while.
Yeah, we don't use the Dow. It's only 30 stocks. So I mean,
So
years ago, I think
yeah.
that we would use that, right? But since it was only 30 stocks, it was a little bit easier to manipulate, and so generally, as you know, we use the S&P or the Nasdaq.
Okay, so we have a fall through day, and we've got the market in an uptrend. What does that mean for most people out there?
Well, it just means that the overall market environment now it has a little bit more of a chance of having a rally. So we generally wait a little bit. We wait for a market signal to try to improve our odds a little bit. So everything, even like looking for stocks that are breaking out, all of these little entry points, rules that we have in the methodology, it's just to try to slightly improve the odds a little bit and help us manage the risk. So we wait for a market signal this fall through day to let us know that the overall market environment is starting to get a little bit better, and that we can get a little bit more aggressive in the market.
Yeah, so it's not an all clear sign. It's not, we don't know for sure that it's going to work. The good news is based on history, all new bull markets have started with one of these signals, right? But there will be some false positives. But the asymmetry of the trade is what makes this so powerful, right? Because if you have a stop loss plan, if you have a plan to tiptoe in, so to speak, and if it goes bad, you just get out. So you can handle. Let's say that you get chopped up a tiny bit 3 times, but on the fourth time starts a new bull market. It's well worth it to heed these signals. And one of the rules, and maybe we'll talk about this when things we learned in house, is that on a fall today, if you were all in cash, if and so a lot of you might not be fully in cash, but if you were, you want to do something, you want to buy something, give yourself some feedback from the market, because we all know that you get much better feedback from being in the market than you do from being on the outside looking in. You don't have that same emotional attachment that you might have when your money's on the line.
Yeah, I mean, it really is amazing at how that feedback works. Where, say, you even have like a 5% position or even 2% position, right? You're a little bit more nervous. You've gotten chopped up. It's been a long, almost 2 years now, right? Where growth stocks topped in, it's really 2 years, growth stocks topped in February of 2021. And so, if you're really focusing on that and you've been trying to get in and out, it's been very easy to get chopped out and to lose your confidence. And so, by putting a little bit of money to work, when you start seeing the market signal, when you start seeing stocks acting better and breaking out, uh, that helps you slowly shift your mindset, where you start to notice that during those times where the markets actually start to work and you're at a beginning of a bull market, you'll start to notice that, hey, some of these positions that I bought, they're actually going up now. They're not completely falling apart and stopping me out, and so that helps build your confidence. And in those real bull markets, the market will continually slowly pull you in over a few weeks, and probably 4 to 5 weeks. Suddenly, you're pretty heavily invested. At least that's my experience. Scott, what about you?
Yeah, our instinct is we want to rush in, we want to get fully invested because we've seen historic bull markets start and how the potential upside. But one of the portfolio managers in house used to say, if it's real, you don't have to buy everything on the fall today. So if this is the start of a new bull market, go back and study. I looked at the COVID bull market. There was one stock, DocuSign, that broke out on the fall today.
Oh wow.
There were 2 that broke out before, so Zoom and Teladoc, I believe,
Hmm.
broke out before the fall today. So those are the 3 big winners from that time period that, let's say, you were waiting for the fall today to get positioned that you would have missed. But after that, there were a plethora of stocks, Livongo, which got bought out by Teladoc, Tesla,
Yep.
Nvidia, Amazon, and I'm just trying to remember some of the tickers because I marked up the chart, right where they broke out, and they all broke out plenty many days after the fall today. So if this is real, there'll be plenty of time to get fully positioned. And the good news is, like you mentioned, we've had a pretty good bear market. It's gone on for it's been long enough. If you count the average growth stock, or if you were to look at ARK or look at Fidelity Contra or T. Rowe Price New Horizons funds, they've all experienced normal bear market activity, down
Yeah.
25% plus, some of those down a lot more. And the time, right? It's been at least 24 months since they put in their tops. The indexes have done a very good job of hiding the weakness in the market because really truly it's been a much, like, if we fast forward 50 years, history will say, well, that let's pretend this is the low. History will say that wasn't really much of a bear market, right? They'll look at the S&P, they'll look at the Dow, the Nasdaq a little bit more. But for those of us that have experienced it, it's been a really nasty bear market, and they've gotten some stocks down 80, 90%. So um, we're it's possible. We don't know, but be open minded. Have the imagination that it could be a new bull market. You never want to say it can't be because then you're stuck. You could be stuck on the outside looking in.
Yeah. The moment you say it can't be, that's exactly when it's going to work, right?
Yeah.
So, I mean, it's amazing how psychology works like that. And we had a fall through day also on January 6th, right? And so we moved the market back to marketing correction a few couple of weeks ago or so. But maybe that was just more of a pullback, right? So we've had that fall through day on January 6th. Picked up a bunch of distribution, ended up moving it back to correction, but now all of a sudden you get another fall through day pretty shortly afterwards. And so maybe that January 6th fall through day was kind of the true fall through day here. We'll just have to wait and see on that. But I think looking on the weekly chart here, Scott, for the Nasdaq, this is probably the first time in over a year where the indexes at least look a little bit more constructive, right? They've settled down, they've formed a little bit more of a constructive pattern here, and they haven't moved that much versus over the last year and a half.
Yeah, I on my weekly video, I screenshotted the Nasdaq. I believe it was about 2 weeks ago, and I took out the ticker and I took out the time frame, and I just said, if you saw this chart, would you be bullish or bearish, right? And I just told everyone, just take a look at this chart. I'm not going to tell you the time frame. I'm going to tell you what company it is. Would you be bullish or bearish? And you were in the midst of this crisis, this banking crisis, for whatever it's worth, and it just didn't look bearish to me.
Yeah.
It just wasn't bearish. And there's a guy that every time we get into these periods in the market that I follow on Twitter, and he always tweets, crisis equals opportunity. You probably know who I'm talking about, but he's right. You go back in history in the long-term capital management crisis and the tech bubble and the great financial crisis, right? That doesn't mean it's an opportunity right as we sit here, but they always set up eventually to an opportunity. So you want to have that mindset that going forward for yourself.
Yeah, and yeah, a lot of times also near the bottom and at the beginning of a bull market, news is pretty bad, and it seems pretty bad right now, Scott. I don't know about you, but it seems pretty negative out there.
I'm always bearish at the start of a new bull market, Arusha. I guarantee, which is partly how I ended up at IBD. That's a whole nother podcast because I was bearish at the lows in 2009 and missed the rally. And I was doing my post analysis in 2009 and I didn't make any money. And I'm like, how did I not make any money? Look at all these stocks. And I was like, I bet Bill made a boatload of money in Apple and Amazon and I was like, I'm going to go work for Bill. That was kind of how I got banged on the proverbial door, called, emailed, and said, I want to work for that guy. I know he didn't miss this bull market. And so, yeah, you have to be careful how you feel because if you're human, like, well, I'm guessing most of us are that watch this show, you will feel negative at the lows. It will feel bad. I mean, I have an account at TD Ameritrade, which Schwab has bought out, and eventually my account will be at Schwab, and maybe that's a stock we can look at later. But I had fear where I was like, I think I need to transfer my IRAs. Maybe Schwab is in trouble, right? And so
Yeah.
uh, that type of fear can, you have. It's okay to have that. You can't fight it, right? But I recognize that I'm pretty fearful here, so therefore maybe we're getting close.
We have to be pretty close, Scott, because I have a Schwab, well, TD Ameritrade account too, and I going through the same feelings that, yeah, and I pulled up the Schwab chart right here where it's just selling off dramatically, and like, what is going on? Uh, so it were probably pretty close to lows because I actually in that account bought treasuries, Scott. I never knew how to do it, and I took the time and I went and I watched some videos of how to do it on TD Ameritrade, and so I do own some treasuries in that account.
Yeah, just so that in case it got locked up or something, you didn't
Right.
have to worry about, liquidating stocks, et cetera, and you were protected, right, by owning the treasuries.
Yeah, I
Yeah.
remember because I remembered I would hear like in-house, like, for the O'Neill accounts, and I'm sure you heard it too. It's that, well, during some of the bear markets, just buy some treasuries, right?
Yeah.
They just park the money in they buy treasuries and not just keep it always in cash. So it's like, okay,
Yeah.
let me just do some of that at least, and I'll put some in treasuries for a few months and keep some in cash, but at least this way, if something else is going on with Schwab, anything can happen in the market. We saw that in 2008, and I don't necessarily think anything's gonna really bad happen. Hopefully to Schwab, knock on wood there. But with the way it was selling off, that worried me. I mean, especially with First Republic, I knew people who had accounts in First Republic. When I started seeing that selling off, I called them and told them, you might want to take some of that money out of First Republic. I don't know what's going on here. Your money's probably safe. I mean, your money's I'm pretty sure it'll be safe, but it doesn't hurt to move some of that money out.
Yeah.
And then all of a sudden you just start seeing more and more of this news. So it's amazing in how the market can kind of lead you in the right direction.
Okay, so there is some negative headlines, some stuff out there that has led to some trepidation in the market, but the market has voted. We have had a fall through day, as Arusha talked about earlier. When we come back, Arusha and I will discuss some of our favorite things working at MarketSmith. We spent 10 years together working almost side by side, and we'll discuss that. Stay tuned.
Are you an active trader struggling to make real profits? Let the Trader's Edge Network team of experts help. Their Money Press method is the breakthrough strategy used by thousands of traders to simplify their options trading and realize weekly income potential. But let the proof do the talking by going to paycheckmethod.com. You'll see a 7-minute video that reveals how the money press works, plus a free 100-page guidebook that explains this method in detail. This isn't about overnight success, but once you discover the strategy for yourself, you too can start on the same path today. Go to paycheckmethod.com right now to get started.
Okay, welcome back to the Investing with IBD podcast. I'm your host. I'm Scott St. Clair. I am joined by Irusha Peiris. So now we're going to talk a little bit about our experience at MarketSmith. Irusha and I both worked there for roughly 10 years together, and it's quite an amazing learning experience. It was just a place where you could learn about the markets, be immersed in it, be surrounded by people like-minded, who loved the markets. I always said it was the best place in the world to work if you liked markets, because it was 24/7 there, and the people that we got to interact with, and we'll talk a little bit about that. So, Arusha, what's some of your favorite stuff? Some of the lessons that you learned from working there?
Well, I think even before starting that, we probably should just mention that we were both customers before, right? We were using the services before it was Marksville. It was called Daily Graphs Online, and we were both customers. And I might have been the first one, I think, who came as a customer to work there, and so people thought I was crazy to do that. It's like, but it almost started a trend, right? You came, and then we had Scott Latone.
Yeah,
The Scott Latonin came afterwards, or
he came
after you, right?
before me. Scott
Oh,
already
we did
worked
come
there
before you.
before. Yeah.
Okay. So yeah, so Scott Latonin was the next one, and then you came. So it was kind of funny, but it worked really well because we started to having people who were already familiar with the product, who were really passionate about the methodology, and just wanted to be there and learn more. So we were in the perfect place, I think, as you said, Scott. So I think I think as customers, you're always wondering, what is it like to be on the inside? And so we had a chance to do that and really get a nice glimpse of it for many, many years. So I think one of the things that I really learned is um, just how to kind of prepare during a bear market, right? Because when we came in, or when I came in, I think it was at the end of 2009, beginning of 2010. So we were at the beginning of a bull market, but it was not easy, and we were still going through some corrections there. But seeing at how a number of the portfolio managers would prepare, and they were looking at a lot of stocks, they weren't, and these stocks weren't perfect. I remember asking questions that, "Hey, this doesn't have an 80 earnings per share rating or 80 relative strength rating. Why are you looking at this right now?" Because they'd be looking at like 200, 300 stocks in their kind of universe. And the answers that I got back were, don't you want to, you might not have to buy it right now, but isn't it better to get familiar with it at this time, as maybe it's building a new base? And so by the time it completes a base, you're ready. You know whether you want to buy it or not. So kind of getting ahead of the game and anticipating, not necessarily buying it before, but you're prepared. So if it does break out, or if it starts to move, there isn't necessarily a hesitation. You can quickly move at that point and not have to learn the story when it's actually moving.
And to that point, Arusha, one thing I learned is that there aren't any secrets. It's not like
Yeah.
they had a better screen or a secret way to find the leaders. We were buying all the same stocks, and maybe we'll talk about Chipotle, one of the great stories that we have. But everybody in-house was all working in separate places, doing their own thing, but they're all buying, recognizing the leadership with the same names. So it wasn't like, the portfolio managers at O'Neill and Company, their performance is so reliant on stock selection. Stock selection is important, but it's not the be all end all. Their outperformance was, a little bit of market timing, avoiding those really bad periods in the market, and and concentration, in the ability to handle the leaders, to not only buy them right, but to hold them right, which is much harder than buying them right, because we can almost all see the cup with handle or the double bottom, but having the gumption to buy it there, get a position that's meaningful, but not too meaningful that you can't handle it correctly, and then hold it as it's moving and gyrating all the way up. I remember the way Bill held Chipotle. Scott used to tell us about Scott O'Neill, who was the president of MarketSmith at the time, and he'd tell us, his dad's still in Chipotle. It was just amazing to me
Yeah.
that his ability to really hold on to that, because unfortunately for me, I was long gone. The profit was burning a hole in my pocket. And so I was just so envious of his ability, to his emotional aptitude to do that.
Well, maybe to talk about the 2010 breakout, right? Which was like kind of the perfect breakout of a couple with a handle at a beginning of a on a fall through day, and so I think it was September 1st, 2010.
Yeah. So this is really, really new for me. I might have only been in there maybe a couple of weeks, maybe a little bit longer, but I was fairly new. And Scott came out of his office. His office is down the hall from where we worked, and he said during the middle of the day, "We're buying Chipotle." We meaning the portfolio managers. And Bill sat one spot of the company, and Mike and Charles and the other guys were somewhere else, and Scott was there by himself. So it wasn't like they all sat in this room and were screaming, "Chipotle's breaking out." They all were prepared. They all saw the same thing: the earnings, the sales, the story, right? Because at that time, me and you were going to Chipotle like 4 times a week.
Right.
It was like our go-to, because we started work so early, and our
They would
lunch was
open at
like at
10:30, I think. They would
10:30,
open at
right?
10:30, right?
So
Yeah.
so it was like one of the few places that was open that early that we liked. So you had the story, and we'd get there early, because if we didn't, we couldn't
Yeah,
get
the
back
other
in
big
time,
thing.
right? Because of the line.
The
What a
lines would really build up fast,
what a
right?
clue
Yeah.
that was, right? To
Yep.
the products and services, right? So everything was just right there. And I what I remember most about that is that there wasn't any collaboration. I think the reason Scott knew other colleagues of his were buying it, because back then they would phone in the orders. So they
Oh,
had a desk, right? And he'd call the desk and say, "Give me X amount of Chipotle." And the guy on the desk might, "Hey, Scott, Mike's ahead of you," or "Bill's ahead of you. Good luck getting filled today," right? Because there would be what's called orders ahead. So some of the guys, if they were the first to do this, they would get in there, get their order in first. So I remember thinking, wow, it was just and it worked. That's neither here nor there. It worked amazingly, but just the fact that they all had spotted the leader, right there at that moment. And there was no hesitation, right? The other thing was, a lot of times people will say, "Well, how do you know it's going to be a fall today?" Well, in the middle of the day, because I remember
yeah.
this was probably
Yeah.
around 9 or 10 in the morning, our
Yeah,
time,
because
Pacific
one of
time,
those rules, and
and
you mentioned
you
it before, in the first segment, but on a falter day, you must buy something. So
yeah.
going to your question, how do you know it's gonna be a falter day?
Yeah, you don't. But at that moment, the stock's breaking out. It's got everything, and the market's up big, a lot like today. The market was up big most of the day. The volume is tracking higher, right? There's a risk and a reward to it. So you just have to put the pieces together and say, this sure feels like a fall today. And you don't want to be left standing. And even if you'd waited to the very end of the day, it wouldn't have mattered. Chipotle, I think it closed on the high, but then
Yeah.
continued to go and go and go until the earnings report, where it really gapped up, if I recall, and really made a big move. So that was one of the number of really ingrained in me stories that I remember. It was a really valuable lesson for me in the last 10, 15 years here from my own investing. All right, so Arusha, another thing that we got that was so valuable there was what we would call the huddles. So tell people about the MarketSmith huddle, right? Remember Scott would come
Yeah.
out and say huddle in 10 minutes, So
Yeah.
or if we were really quiet, if the market was quiet and everyone was kind of sitting around, he'd say, "Let's do a huddle," right? And we would have just an incredible learning experience.
Yeah, and especially during corrections where things would get slow. Yeah, Scott would come out and he would come out almost every, he'd probably come out every day and do this, sometimes multiple times during the day. And he would say, okay, let's do a quick huddle. And he would go over kind of market lessons. Like, hey, pay attention to this. How many days are we in an attempted rally, or what stocks are setting up, and we'd pull up a stock, and we'd all take a look at how it's building a base, or which stocks are hitting relative strength lines are that are hitting a new high. So it was almost in many ways, and there's I want to say maybe this is during like 2011 or so, where it got, the markets were really tough, and so we weren't doing that much, where it was essentially a daily hour long type of lesson, right? Which was awesome, for the market junkies in the group. We loved it, because you just learning this in real time, or seeing a lot of these details in real time. And I remember a few kind of phrases that Scott would say over and over again in the huddles. Like, pull up this stock and see how powerful this breakout is, or see how strong this move. And he would say, that's a sea change of sentiment, or boats don't have brakes, right? Meaning kind of like, with that Chipotle, that powerful breakout in September 1st of 2010, that the breakout was really powerful. The market was starting to move, and the momentum was able to just kind of keep going and going, and went a lot longer than any of us could imagine, except Bill, right? Because he's been through a number of these cycles and identified the leaders. So all these kind of little kind of details, throwing it at us real time, was perfect for us. We were customers, and we wanted to learn more about the methodology.
Yeah, and so Scott O'Neill, gosh, hundreds of huddles over a 10-year period probably.
Yeah.
And but also, the guys that were like rock stars to us that you saw in the hallway, and they're all amazing people, Charles and Mike Webster, but
Right.
they're portfolio managers at William O'Neill, and you just think, wow, a little bit starstruck by all of them, Steve Birch and
Yeah.
them, and so you'd get to meet them and interact with them, and they would come and do huddles, and then I remember the first time we went to a meetup, and we had dinner with Charles and Mike
That's
at
right.
BJ's restaurant,
That's right.
we all sat around. I just thought that was the most
I couldn't
amazing
believe I was
thing
sitting
ever.
next to Charles Harris.
Yeah, exactly,
It was fun.
exactly. So it was really a great experience to learn, how these guys handled things and in the way that they did. And a few nuggets that I got from Scott per Bill, and Bill would talk to us once in a while, but mostly it was passed down from Scott. But he once said that Bill rarely got completely out of the market in a huddle, and I wrote that down, and I was a little bit floored because I always thought, market and correction, you go to cash, market and uptrend, pedal to the metal, you go 100%, if not more. And that was kind of how I traded too. It was full speed ahead, or full stop. And he said his dad would be probing always. So even if the market was bad, he might have a little bit of Apple or a little bit of Google, or in this environment, maybe he'd have a little bit of Nvidia, or a little bit of maybe some of these other semiconductor stocks that are acting so well. And they just gave him that feel for the market that was so amazing. So I've taken that to heart, and it's really helped me, especially in periods where I want to get bearish and get negative and get worried. And I always kind of think, well, let's have something. Let's have something in there, even if it's a 5% position. If a 5% position were to go down 10%, let's just say it got away from me, that's half of a percent on your whole portfolio, right? So you can survive that. And that's definitely been something that's helped me in the last, 10, 15 years. And then, the stock's not going to double or triple because of the chart. So the reason our charts look like they do is because that's what Bill wanted. He wanted a chart with earnings and sales and return on equity and fund ownership and proprietary rankings, et cetera. And that's like 80 to 90% of it. The other 10 to 20 would be the chart. The chart can help you to identify the entry. The other thing he loved about charts is it allowed you to look at hundreds and hundreds and hundreds of stocks. Back to your story, he'd actually look at thousands, probably a
Yeah.
couple thousand on the weekend, and whittle it down to a manageable level. So it allows you to see, the whole market and then bring it down to a number that's manageable for you.
Yeah, and Scott, before we run out of the time in this segment, I just wanted to bring up one last kind of story here, which I think it was almost kind of the perfect way to end kind of our MarketSmith alone type of experience, where we were our own separate company and then slowly started to get more involved with IBD. But it was when we did a trading summit in Chicago, and this was the first ever trading summit. We did trading summits all over the country later on, but we did this one trading summit, and Scott O'Neill was the keynote speaker. And you presented, I presented, Justin presented, Amy Smith, and we all had like 20 minutes presentation where we kind of went over one concept, and we went through a lot of animation of charts. And it was unbelievable how many people showed up to this thing. It was over 450 people. It was standing room only. It was always fire hazard, I think.
We had to
Um,
tell some people they couldn't show, and they
Over
were
100
pretty
people had to turn.
upset.
Yeah, over 100 people had to be turned away
Yeah.
from the event. And just kind of the energy in that room. It was. I think it still was probably the most memorable presentation. But that was kind of the beginning of the trading summits. And it was almost a perfect culmination of what Scott had taught us, and we shared with everyone else at that point, going over all these kind of lessons.
Really love those charts. I've been using them forever. There are a lot of things in the pipeline. The future is really exciting. We hope to take some things to the next level, and we have a great clientele who really care about the charts as much as we do. We're hard at work in the background. We really are working on some new features, so stay tuned, and we hope to have some really great updates in the future.
Are you an active trader struggling to make real profits? Let the Trader's Edge Network team of experts help. Their money press method is the breakthrough strategy used by thousands of traders to simplify their options trading and realize weekly income potential. But let the proof do the talking by going to paycheckmethod.com. You'll see a 7-minute video that reveals how the money press works, plus a free 100-page guidebook that explains this method in detail. This isn't about overnight success, but once you discover the strategy for yourself, you too can start on the same path today. Go to paycheckmethod.com right now to get started.
Okay, welcome back to the Investing with IBD podcast. I'm your host, Scott St. Clair, and I'm joined by Irusha Peiris, portfolio manager at O'Neill Global Advisors. So we had a follow today, Irusha. Let's start talking about watch lists, stocks to watch, anything on your radar that we can discuss.
Yeah, so I think Scott, we can start off with Southern Copper. Um, and so here's a stock that's forming, and so I have a weekly chart on the MarketSmith charts here, and working on a double bottom, getting back above the 10-week line here, and really it's built this really long trading range over the last year and a half. So a breakout past that 80 area, especially on big volume, would be a significant breakout.
Yeah, it reminds me a lot. On Twitter, we've been doing these historical charts, and Cleveland Cliffs was one that
Hmm.
we did recently in 2004 when it broke out of a really long base. So I don't know, Southern Copper reminded me of that. You
Hmm.
also have the really large base down to the smaller base, right? And that virtual summit that you talked about, well, one of the
Yep.
virtual summits that we did,
Well, trading
you
summit.
Yeah, you did a study on that, right?
Yeah,
How the
faulty to
sometimes,
constructive. Yeah.
yeah, the bases start out large, they get smaller and smaller and tighter. So this is a stock that I do own. I did buy it today, kind of on a shakeout plus three buy point. The Jesse Livermore shakeout plus three buy point undercut that low and started to jump up. And you had the market environment, so I wanted to just put more money to work. And this is one of the few stocks that has kind of jumped out at me earlier today. So I like that type of double bottoms are probably my favorite. I really like when they shake you out because I always get shaken out of good stocks, so I
Yeah.
might as well be on the other side of them once in a while too.
They're always hard, yeah. It's especially after you get shaken out. It's always hard to get back into them. So yeah, I know you love these, and I've been trying to pick up on these a little bit more and more because it's hard. It's hard after that kind of shakeout. But Scott, I'll ask you a quick question here about do the fundamentals, kind of the negative earnings and sales. Does that bother you?
Yeah, I mean, obviously, this is going to be super, super correlated with the price of copper,
Yeah,
and
yeah,
so it's kind of a different type of purchase than I would make in a semiconductor stock or a medical products stock, et cetera. So yeah, these are a lot harder. You buy gold stocks, you buy copper stocks, or you buy coal stocks,
mhm,
and even a little bit with oil stocks too. I find them they're look, all stocks are hard, but they seem to be extra hard because you're watching the market, you're watching the stock, you're watching the underlying commodity, and it can be you can just get so many mixed signals. So yeah, it's I'd prefer this was a pharmaceutical stock with earnings last quarter up 82%, but one thing about commodities, like I think about like Jesse Livermore from, Reminiscences of a Stock Operator who would trade commodities. It's all supply and demand, right? It's
yeah,
just flat out supply and demand. And if we're all going to be driving EVs, if they're going to get rid of these ICE vehicles, then there's just not enough copper. It's flat out just is not enough. So this stock almost has to go up if we're going to force the world kind of away from these combustion engines that we have. And because I can't think of the number, but an electric car has like 10 times the amount of copper
wow,
that
I didn't know that.
that for lack of a better term, regular car has.
Yeah, no, that makes sense. I mean, every time for commodities and things like that, or EV, when you think of commodities, you think we've always been talking about lithium, right? And those lithium stocks went on some really nice runs over the last year plus or so. But yeah, I didn't realize copper was a that much more copper was in an electric vehicle.
And I always like the narrative. I've become big on the story, ever since we talked about like, Bill, and it's not just the chart. So, and I listen to a lot of podcasts, and I'm by no means am I an expert on any of this, but I guess it takes like 20 years from start to finish for a copper mine to get
Yeah,
going.
something like
And
that. Yeah.
so, you could find a copper mine in XYZ country today, but you're not going to get any copper out of the ground until 2043. That's
Wow.
incredible to me. Now, maybe the technology will accelerate as we go forward. Everything seems to happen so much faster, but uh, you know, right now it kind of is what it is. And so you can see really big moves in commodities in short periods of time. Maybe that's why it appeals to me a little bit, like if they're because they can go up pretty fast. And the other way too. But again, the asymmetry is in our favor. If
Hmm.
as long as I respect my stop and can get my stop, the most I'm going to lose is 4, 5, 6%, with the chance to make 20, 30, 50%. That you want to do that all day, and you'll be good to go. All right, so let's and pull up ERO. I know I'm throwing you a curveball here a little bit, Arusha, but I go to the daily,
Okay.
and you have confirmation in the group. So
Okay.
this stock, um, Although it closed at 18. I guess it didn't close as well as I thought, but at one point it was as high as 1872. And I
Mhm.
tried to buy this in the morning. I had a limit to buy it at 1750
Oh,
because
wow.
the low is 1758. Yeah.
1558, yeah.
And it goes to show you about using limits, but it's a little thin. It trades 100,000 shares a day on average. And I was trying to buy it across a number of accounts. So on the open, I thought I better use a limit, and I didn't get filled, but but at least you had a little bit of strength on another stock in the group as confirmation. All right, so let's go to the next stock. Let's talk about MELI, Mercado Libre. MELI is the ticker.
Yeah, so, this is a stock that's, been acting pretty well. It broke out of a large consolidation around a couple of months ago, and then built a flat base, tried to break out of that and pulled back into the 10-week moving average here. And so, it's we kind of mentioned the faulty to constructive concept before. Here it's kind of getting tighter and tighter too. It's a little bit more ascending right here, but you had a larger consolidation, and then you go to the flat base, and then it's even tighter here. Mark Minervini talks about the his VCP patterns that have a very similar type of concept too. So it seems like it's been hanging in there. It's tightening up, and it's let's see, well, 2% off below the pivot right now. So it's one of the better acting retail stocks. And this is a stock back in the past. I'll pull up on a monthly chart here that, using the O'Neill methodology, has been one that trends really well when the markets are acting well.
Yeah, and so it got hit really hard in the bear market that we've had.
Mhm.
From what's that 1900 down to, gosh, as low as 600. But is intriguing to me is that it's come back much better than, say, the C Limiteds of the world.
Right.
Um, some of the other stocks that just haven't, they don't look as good as MELI. And MELI has, back to your question about earnings and sales, MELI has all the factors. The last quarter earnings were up 450%, revenue up 41%, return on equity 29%, thing and fund ownership. So you've got, it's not very big, but Contra has a small position, Fidelity Contra, JP Morgan, they all have kind of small probing positions, it kind of looks like to me. So if they start to maybe get more confident in the markets and or this company, you could see the stock really trend going forward. So this is another. It's a watch list candidate. I do not own MELI at this time, but I would think it would be a watch list candidate for most people using our system.
Yeah. Now, one thing just to bring up, because I know people, or people have been doing this for a while, might ask this question, but there is a bunch of overhead supply here, or over last year. Meaning, so overhead supply, it was trading higher, as you mentioned. It was trading almost at $2,000 and came all the bit back down to 600. And so there are people who bought it at $1,600, $1,500, things like that, where the stock sometimes will that those are resistance areas, and so it might have a little bit more trouble getting through those versus a stock that's breaking out into all-time highs. So that's one thing that, it's always a little bit of a negative check mark. They can hang in there. I mean, they definitely can overcome it. During a bear market, there are going to be a lot of stocks that have overhead supply, but that is something just to bring out, to be aware of.
Yeah, and as the stock moves, maybe that's kind of why it's been just kind of stuck in the mud here
Mhm.
above this pivot for a number of weeks, is you're running into that. But as it moves sideways, overhead resistance kind of falls away. Anyone who's owned this stock for 2, 3 years, watched it go down in half or more and then all the way back, they're probably not looking to sell anyways. So you've probably, as you get further and further to the right, you'll lose some of that resistance, and maybe that will allow the stock a little bit of room room to run. But yeah, it's a good point. It might be, in hindsight, when I think about why it's just kind of sat here, although the market's kind of sat here for a while, is you've probably in that kind of zone of overhead resistance. All right, and then let's look at something that's a little faster mover that I'm sure a lot of people have either watched and or owned. It's AEHR is the ticker. I guess it would be Aehr Test Systems. So if you like volatility and speed and stocks that move, this would be high on your list. I do not own this one. I have owned it before. I did buy it when it broke out or gapped up maybe 5 or 6 weeks ago, and it was okay. I did all okay with it. Not it's much higher than where I sold it, but I just found that it was a little hard to hold on to because of the volatility in the stock. A 10% move from high to low was not it's just like normal action for that stock. So you'd want to have a position accordingly, and then you have that gap down on the that was the news, I believe, where Elon Musk, might have been Tesla Investor Day, where they talked about um,
Mhm.
uh, going away from the silicon carbide that AEHR uses. And so, but stock actually held up really well considering. I mean, at one point it was down to maybe 22 and change or something, 23
Yeah,
and a half is the
23 and a
low.
half. Yep.
It would have been really difficult. But it closed pretty good. Another stock in the group, ACLS, did the same thing that day. So, um, this has been the leadership in the market has been semiconductor stocks, which is good because if the market's going to get legs, there's a lot of merchandise in semiconductors. A lot of them have quarterly earnings and sales. If that's, if you've got like a checklist, there's plenty of merchandise that meets those checklist items. Now, AEHR does report earnings tomorrow at the close, Thursday, the 30th at the close. And I think before we started this podcast, we checked the option market, and it's pricing in like a 17.5% move. So
That's pretty low
um,
for this stock.
yeah, yeah, I think Ali mentioned that in the last 3 times they've announced earnings, the stock's been up at least 25%.
Yeah.
So keep that in mind if you're considering something like this. You've got the earnings tomorrow.
Yeah, I mean, if you don't already own it and don't have a good enough cushion, yeah, I mean, your chances are you're taking a little bit too much of a risk here, or reduce it to adjust. Kind of like what Scott was talking about before. If you have a 5% position and you're down 10%, you're taking a 0.5% hit on your overall portfolio. So you want to do that with this type of stock. You definitely anything can happen in the market, and you definitely don't want to get caught in a 20+% gap down. Anything can happen. So just take that in mind, and make those plans ahead of time, and kind of figure out that risk and the potential downside ahead of time. So at least you know whether what you're getting yourself into.
Yeah, the earnings reports have been, a massive wild card, and it's gotten, worse and worse in the last few years. I'm torn on earnings. I tend to hold. I do not own AEHR, but I tend to hold through earnings. But I do tend to reduce my position size and just do the math. Imagine I have a 10% position and it's down 20%. So my whole
Mhm.
portfolio is down 2% that day, barring all the other stocks, of course.
Right.
If I'm up 22% for the year, I can live with that. Now I'm up 20 for the year. If I'm down 3% for the year, I don't want to almost double my downside move for the year in one name. So I would really adjust the risk accordingly. So that's how I like to think about the earnings report. Earnings come out 4 times a year, and if you're ever going to have a really big winner, an Nvidia, a Tesla, a Google, you're going to have to sit through an earnings report or a number of them. Jim Ropel talks a lot about, sitting through these beat and raise quarters, 3 or 4 of them. And so it makes it difficult to think about how to handle these because the earnings have gotten, to become a very highly volatile event for most equities.
But that being said, you don't necessarily. I don't know. Are you going to buy something on the day of earnings? Would you
Uh,
initiate a position on the day of earnings?
yeah, I bought AEHR the day after earnings on January 7th.
Yeah, but on the day before earnings or something, would
No,
you
I
buy
would
something?
not
Okay,
initiate a
okay, just
position
want to
in
make sure.
this.
Yeah,
Yeah, I don't own it, nor do I intend to own it. Yeah, just because I can't, I wouldn't know how to control my risk,
exactly. Right.
and if you buy it the day before, you're going to be up or down 0.5%. You have no cushion. So that's the other thing. Now, if I don't really, we're off. This is a whole nother podcast, but to me, all every dollar in my account is my money. So I don't like to think about like I tend to come in like with the mindset that okay, I own this stock. What do I, regardless of where I own it from, do I think it's going higher or lower?
Right.
That's really my mindset, and I just stole that from Paul Tudor Jones because he talked a lot about that. How people would ask him what he thought of XYZ, and then they'd ask, well, where do you own it at? And he would say, well, it doesn't matter where I own it at. If I tell you I think XYZ is going higher, it shouldn't matter, or lower. So I tend to right or wrong, that's how I tend to look at them. So I don't, I know a lot of other people though use the cushion philosophy, which
Mhm.
is fine too. In the end, have a plan, whatever the plan might be. Have a plan. All right. Well, Arusha, it's been fun. Hopefully they'll have me back. Hopefully I did okay. Let's hope that Justin does find his way home from Hawaii so that he can have a slot back. But that'll do it for this week. I really appreciate you joining me for this ride. I miss our stock. We used to do a video together. We used to go on
That's right.
long bear market walks at MarketSmith. That was
Our
one of the
10,000
stories
steps.
that we didn't get a chance to talk about because uh, and we talk stocks and things like that. So it's been a real pleasure to do this with you.
No, no, it's always great, and maybe you can fund Justin's next vacation so you can be back on.
We'll put them in AEHR and some options.
There you go.
Let's see what happens. Yeah. So next week, our guest is portfolio manager David Lundgren of Motor Capital Management. I really appreciate everyone tuning in. We will see you next time. Thanks a lot.
Make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.